All right, today we are going to be covering how we identify investors, finding investors, the first few steps that we take in capital raises. And it really is going to start with understanding who we're raising money from and how we are positioning ourselves in correspondence to them or in relation to them, right? I always talk about alignment and drawing exactly where you are and what you're offering to who these investors are and what it is that they're looking for. So let's go ahead and dive on in. First thing is I define three main investor categories. These are my definitions of accredited, professional, and institutional classes of investors. Accredited investors, these are going to be your retail investors, smaller checks. Professional, these are people who are professionally investing, whether it's for themselves, whether it's on behalf of clients, on behalf of their fund. Right? These are going to be a little bit larger check writers. Maybe it's ultra high net worths who have now transitioned into solely allocating and managing their own capital. This could be smaller family offices. And then we have institutional investors, larger family offices, multifamily offices, financial institutions, fund of funds, big check writers, endowments, pensions, lots of capital under their belt, right? So this is how I start to approach things and really understanding what do I have to offer? Who is it going to be the best fit for? And what do I need to consider when approaching these various groups of investors, right? I always recommend if you're raising from retail investors to not raise from retail investors. Most of what we do is solely focused on larger check sizes, going after more of the professional and institutional class of investors in the first place. We don't really talk a lot about retail investors. If you want to raise money from retail investors, there's a lot of examples in what not to do out there, but we're not going to cover that very much. But what it is important to understand is retail/accredited investors. This is where you really have to optimize. If you look at the third line down, your focus really needs to be marketability. This is why you see people like Grant Cardone and these other similar firms really leveraging social media marketing, advertising, paid ads. And there's a lot of firms right now running paid ad campaigns to try and optimize for more accredited/retail investors, but these are going to be much smaller checks. Capital available, if we look across the board, this is the group of investors with the least amount of capital available. So when we're approaching a capital raise, these are the things that I start to keep in mind, right? Capital available, time available. We start to go over to the left, professional and institutional. It's important for you to understand if you're a founder, if you're raising capital for real estate or acquisitions or private equity, and you're wanting these larger check sizes, $1 million, $2 million, $10 million, $50 million JV partners if you're doing larger projects. How much time do these people have available in relation to the amount of capital they have available? Because one thing that we misassume and where there's often immediate misalignment with potential investors is that we assume they have a lot of time to look at our deals. So we assume if we just send them all the information in the world, they're going to look through everything, when in reality, the more sophisticated investor, likely the less amount of time that they have and the less amount of time and resources they actually spend on evaluating new potential deals, right? So we start to know what we need to optimize for in our positioning and how to get through the door quickly, how to deliver value fast, right? As we start to go down some of these levels. Another interesting category I want to briefly mention before we talk about some of these other steps is risk tolerance and education needed, right? If you're going after institutional investors, they likely need very little education because you're not going to convince them to invest in something that they don't invest in, right? You're not going to convince them to invest in something they're not intimately familiar with and educated and most likely subject matter experts on in the first place. And so a lot of what's going to be needed here is overcoming the due diligence factors needed and really making sure you're well prepped and well versed and well prepared. We can see some of the different factors there. But here's what I really want to dive into, which is understanding the difference between demand generation and demand capture. Now that we really start to get a view or scope of the market in terms of the different types of investors, it's important to understand where you fall into this and where your focus should be. You see, maybe we'll even simplify it a little bit. And the demand generation side, this is where you need to create demand for what you're offering. If your investment product or your whatever it is that you're raising capital for, if we're to view that as a product, who are the customers for this product? Do we need to create these customers or do we just need to find these customers? And this is really the beginning nuance of demand generation versus demand capture, right? Meeting existing demand is going to be more similar to a checklist of requirements versus needing to create demand. This is going to be the need to convince investors. And so this is why a lot of groups on the retail investor front are focusing on creating demand, right? They're creating new customers for their product. They're trying to get people to invest. This is why they pitch cash flow and upside and wealth creation and all the buzzwords. They're really focused on investor education. This is investor seminars and webinars. These are, ebooks and pamphlets and all these things, marketing efforts that they're using to generate demand. But the problem with this is that these check sizes are really small, and managing these investors is a big headache. And if you want to do a $50 million fund, even if you want to do a $20 million fund or, a $10 million raise, trying to reach some of these numbers solely with retail investors is really hard, and it takes a lot of time and it is very expensive. Most people do not have large enough networks to fill multi-decamillion-dollar raises with just retail/accredited investors. Right? This is why then they'll turn to paid advertising, yet you're spending thousands of dollars per investor that you're acquiring through Facebook advertising or through YouTube or wherever else it is that you have ads up. Right? And so your focus needs to shift to understanding the demand capture market. And when you really want to institutionalize and go after larger check sizes, this is exactly what you do. Is you realize you are meeting a checklist of requirements. And all of a sudden, you're dealing with people who are professionally investing. And yes, they are active in real estate. Yes, they're active in X or Y or Z. And so you need to really know how to stand out from the rest of the crowd, how to meet that checklist of requirements, and how to really capture that existing demand. Your area of focus, ultra high net worths, funds, family offices, institutions, right? Most of these have mandates. They know what they're investing in. They're very experienced and familiar investors. They know how they want to invest, which is another very important part of it. Right? There's an increasing factor of sophistication as we move from who we need to generate demand with versus who we need to capture demand from. Right? Your increased level of sophistication with these investors is going to be reflected in a few different ways. But there's really only three ways. If you're trying to find investors, and you're like, Nikita, this is great, everything that you're saying, but here's what it really simplifies down to. If you're trying to find more investors, you're trying to talk to more investors, what do you do in order to make that happen? So we've gone over in this first part who these investors are, which I list three different types, right? If we just go back to that, I say, hey, there's basically three different types of investors: of retail, professional, institutional, right? Varying levels of sophistication and whatnot. Match with what you are offering with what they are likely looking for, right? Understand where you fit in the market and what you start to need to optimize for, which you need to be focusing on capturing demand. So then the next question is, well, how do I capture that demand? First, you need to understand you are simultaneously capturing the demand for your deal, right? This is, once again, where your deal fits in and where your focus should be with these groups. You're simultaneously capturing demand for your deal while creating demand for yourself or for your firm, right? You are still needing to create demand for you. And so we have to walk both sides of this path. And there's really only three ways to do that. The only three ways to scale efforts when you are focused on capturing demand is you need a high volume, right? Every capital raise, every effort needs to have some high volume sources or mechanisms to get more leads through the door. This is also why simply going after retail investors gets very, very expensive, because smaller check sizes means an increased number of investors that you need at the end of the day. Well, how are you getting these people in your network? It starts to get very, very pricey, but you need high volume mechanisms. These are from the right investor data sources. These are outreach systems, whether that's on LinkedIn. This is content. This is thought leadership. This is also outbound email campaigns, targeted email campaigns to interested investor data sources. This is leveraging a multi-channel approach. If you look at any firm who's managing more than probably $100 million, they all have internal investor relations teams whose 24/7 focus is to, yes, relate and communicate and to have relationships with current investors, but also to expand that pool of potential investors, right? That is their 24/7 focus. These firms are doing high volume through person to person. You can also do high volume through technology and automations, online presence, content, but you have to have high volume mechanisms in place. That's the first step. The second step is unique positioning. Your unique positioning ties back into exactly what I said here, which is you're meeting demand for your deal while simultaneously trying to generate demand for yourself or for your firm. And you do this by really understanding investor alignment, which is why I started with these different types of investors, because the better you understand this, the more easily you can start to align to these types of investors with unique market positioning. What are going to be the biggest factors that they want to say yes to, right? What are going to be the biggest risk considerations that they're looking at? What are they underwriting? How are they viewing the market right now, right? You start to position yourself uniquely in alignment and in coordination with this to really stand out and cut through a lot of the noise quickly. This is a value proposition and articulating what it is that you do, right? Anytime, especially if you're raising money for highly technical things, but this also applies to if you're raising money for similar things to what a lot of other people are raising money for, the better you can articulate what it is that you do, the more clearly, more concisely, specifically in relation to the types of investors that you're raising from, the more you will cut through the noise once again, the more you will establish yourself as a credible, knowledgeable, trusted source in that space, right? The more your pitch will stand out, the more you'll resonate with these different teams that you're talking to. Work on your unique market positioning is also part of how do you view the market? That's very unique. That's very compelling. Investors want to hear how you view the market, right? Not only how you stand out in the market, which is a different set of factors, but also how you view the market and what your thoughts are. What is the thing that you see that everybody else seems to miss, right? Here's where we start to get into unique positioning. And then the last part is demand indicators. You need high volume paired with your unique positioning to the right demand indicators, which a lot of this comes down to verified intent-based data sources, right? These are data sources that are providing you with active investors. They're providing you with market data to know and really understand what is being raised for, right? Because yes, you can be trying to find active investors investing in X asset class in real estate. However, if you look at the broader market, is the market timing good for your specific pitch or for your specific approach in that asset class X in real estate, right? So understanding the market factors, the market indicators, as well as their market demand for what you're doing, in addition to specific investor indicated demand, right? There's really good resources like PitchBook and Dakota. We actually have our own custom investor databases that we've built out based on intent base and B2B matching and B2C matching and all these other factors, but you've got to have the right demand indicators in order to know who to focus your high volume efforts towards and what to be saying to them. And then you need some type of mechanism to get quick feedback, meaning a lot of times you reach out to investors, many people reach out to investors and they don't hear anything back. Well, non-responses are not actual feedback, right? You need to be optimizing to either get to a yes or to get to an intelligent no, right? And if you're not getting to an intelligent no, that's a really good factor that you're probably talking to the wrong people, right? That indicator alone is likely saying, hey, these people really aren't interested in the first place. You're looking in the wrong spot, right? So this is really the foundations of how we approach identifying investors. Just to recap, knowing the right types of investors that we're going after, understanding what they're looking for, what are they underwriting, what are they prioritizing, how do we fit into the market, meaning what do we need to be focused on? Are we focused on creating new demand? Are we focused on meeting demand? And as we are focused on meeting demand, how exactly to do that and to maximize our efforts there with high volume approaches, high volume systems. If you're looking at your systems right now and you don't have new investor contacts or connections coming in on a weekly or monthly basis, that's an indicator that you need to start putting high volume mechanisms in place, whether that's outbound channels, content, whether that's, bringing in new partners, building out teams, whatever it is, that something needs to be producing high volume outcomes while being paired with unique positioning, right? If you are constantly telling yourself, man, investors just don't really get what we do, right? Oh, I just wish they would understand. If they understood, they would say yes. And you're saying that to yourself, then you really need to work on your unique positioning, because something about what you're saying or how you're positioned isn't allowing investors to see that and isn't allowing your investors to connect with what you think they should be connecting with. So work on that alignment, how you're saying it, what you're saying it. Are you saying it in the right way to the right people based on what their priorities are? Do you have everything needed in order to meet the requirements for, just basic preparation and, pitch articulation? Do you have a clear value proposition? Right? Do you have an articulated way of how you uniquely see the market? And then are you looking at the right demand indicators? So let me know if this is helpful. If you guys want more one-on-one help, or you want us to take a free look and free audit at your capital raising efforts, reach out on our website, investorready.co, or email me, nikita@investorready.co, and we will gladly take a look at what you guys have going on. Like I said, we accelerate capital raises, we take deals to market, we do materials, investor systems, and investor introductions. So we are going to keep dropping a lot of content like this. Let me know if this is helpful. Thanks, guys.